Vic.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday. That means John Penn's here, so we've got stuff to talk about this morning. For a change, right? So we'll get into some stuff with John this morning. This morning, futures are down a little bit. We've had a couple of good days in the market, so a little bit of a pullback, not surprising. S&P futures down about 19 points right now, not big. But this is pretty much following the news yesterday that President Trump did impose a 25% tariff on both steel and aluminum products, as we discussed yesterday, or as we say in Texas, that tin stuff. So it's aluminum. But anyway, so 25% tariffs there. Markets are trying to digest that a little bit this morning. But again, interesting though, right, is that, when we saw tariffs being put on Canada and Mexico, markets were down very sharply that morning, about 1.5%. They did come back during the day. This morning, markets are down just a smidge on this news about tariffs on steel and aluminum. Now, not as big of an import issue as, of course, Canada and Mexico, so that is one part. But what is becoming, kind of more evident now is markets are coming to grips with this whole idea of tariffs and what's going on. Now, we've got a two-part article coming out this Friday and next Friday talking all about tariffs on inflation, corporate profits, earnings, those type of things, how that all impacts, how tariffs impact all of that. So, and we're looking back at President Trump's first term to see how the Chinese trade war impacted all the different variables of the market. So I'll be out on Friday. But as we've talked about before, the thing that gets markets, again, I'm still getting a lot of emails like, oh my, these tariffs is going to be terrible for the market. These are not unexpected exogenous events, right? These have been well telegraphed. Markets are adapting to what that is. We've seen rotations in the market as of late. We were just talking about in this past week that we saw a lot of flow into financials and to those areas of the markets out of technology, and technology got very oversold and out of favor, and financials were very, very overbought. Well, yesterday we saw some of that rotation, right? Financials sold off a bit. Technology did pretty well yesterday. So again, that's how markets are working. We're just, they take this news in, they start to adapt to it. What does it mean? They adjust the earnings expectations, and then they start buying stocks. And this is why these events are not, as we've talked about before, when you see these headlines like, well, if President Trump, institutes these tariffs, it's going to be a big bear market. You need to get out of stocks now. That's not the way it works, because markets adapt to that, right? The thing that gets the markets is something totally unexpected, right? When you just wake up one morning and there's this news event like DeepSeek that markets weren't expecting at all. That's what gets the markets, right? And that's where you have potentially these bigger issues. But overall, markets are doing fine, holding in here well. Nothing extraordinary going on right now. Economic data continues to be okay. But interestingly enough, we do have some inflation data coming out this week. So all eyes are going to be watching CPI, PPI later on this week, Wednesday and Thursday for those data points. So we'll see what that says. But if you take a look at consumer expectations, and I posted this chart on Twitter this morning, actually two charts. One is expectations of better financial conditions of of consumers in the next year. That's declining fairly sharply. Expectations of higher incomes are declining sharply over the next year. So those are not inflationary. If consumers are concerned about their level of income and they're starting to curtail, worried about their level of spending over the next year, right? Are they going to be able to, kind of sustain the same lifestyle they're in? That's not inflationary, right? That's the kind of data that feeds into CPI eventually over time. But again, there are, as we talked about before, the economic data and inflationary pressures are declining, not increasing. And again, just have to pay attention to what consumers are doing. And again, this is stuff that, in the short term, there's certainly inflationary impacts. Of course, right now, hearing a lot of stuff on television about eggs, right? Price of eggs have been soaring because of this avian flu. Trader Joe's had to put a limit on 1 carton of eggs per customer per day because people were going in and basically buying 100 cartons of eggs, and then they're reselling them. So, people can figure out a way to make money, in this market. But those are the type of things that occur when you have a shortage of a product. Yes, we have a shortage of products because of these chickens. We killed like 100 million chickens last year worrying about the flu. So that has all led to a shortage of eggs, right? So, but that'll eventually work itself out and those prices will come back down as supply comes back online. And as we've talked about before, it's always about supply and demand. If you have a big shortage of supply, same amount of demand, prices are going to go up. So let's talk a little bit about what you need to know before the markets this morning. Again, as we noted yesterday, in particular, the markets are doing fine, right? Nothing wrong with the markets at all. Markets rallied a bit yesterday, and kind of recovering from that sell-off that we saw on Friday. It wasn't a super strong rally all day, but it was a decent rally. And again, we just continue to kind of work within this kind of this trend of lower highs, and at the same time we have these kind of lower lows that are getting built in. So we definitely have this kind of this more, the term bearish really isn't the right term, but it is a kind of a bearish pattern that's developing. These lower highs and lower lows certainly suggest some exhaustion within the markets. Money flows remain positive, but they are declining, starting to decline here a bit. Again, money flows got to, pretty much levels where you normally kind of see, kind of short-term market peaks. And so again, we may be entering into a period, and again, just statistically speaking, the month of February, the last half of February, which we're getting into this week, is typically fairly weak. It's the weaker part of February. So again, this kind of pattern that we've got going on right now and these weakening money flows certainly suggest we may see a little bit of weakness in the markets here over the course of the next couple of weeks. Again, we could, the 100-day moving average currently sitting around 5,900 ish on the S&P. So, a pullback from 6,000 to 5,900, right? It's only 100 points, but that's going to kind of wake investors up here a bit, particularly given the amount of FOMO, and we'll talk about that this morning. Retail investors have been just piling into the stock market here over the last couple of weeks. And again, we're very close to short-term sell signals, so that would also kind of support a bit of a, kind of a bit of a pullback here, some more of this consolidation, kind of more of this drag that's been in the markets as of late. Again, nothing overly concerning at this point, nothing to, suggest that you need to make radical changes to your portfolio mix by any stretch of the imagination, but certainly some indications that, we are starting to see a little bit of weakness creep into the overall market. And the one thing that may contribute to that a bit more is the dollar. The dollar is very close here to triggering a buy signal. And again, we've had this nice correction in the dollar. That's been supportive of these kind of market rallies, despite, the impact of tariffs and all this other news headline we've had. This little bit weaker dollar has been dragging some money flows into the U.S. So again, but we're very close here to seeing a buy signal. So if we see another surge in the dollar back towards, 110-ish, that certainly could weigh on markets here over the next couple of weeks. So there's some things kind of lightening up, kind of lining up here a bit that, may suggest a bit more consolidation, a bit of a pullback here. So, one thing you may want to look at your portfolio is just readjust risk. If you haven't really liked how the portfolio has been performing over the last, couple of weeks in particular stocks not performing really the way you expected, this is a good time. Use this opportunity. The market's been holding up well here. Use this opportunity to kind of rebalance that risk in your portfolio just in case we do get a couple of weeks of kind of seasonal weakness as we get ready to head into March. That's what you need to know before the bell this morning. When we come back, we'll pick up John Penn. Lots of questions from our last weekend's Candid Coffee. We're going to kind of get through some of the ones that they didn't get to cover. We'll talk about some of those this morning right here on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. John Penn joining me.
Good morning.
Morning. So, there's been lots of debates over shutting down Department of Education, and that's really failed as kind of a government agency to ensure that our children are getting a good education. Well, I have proof. I have further proof, by the way, that it's probably a good idea that we try something different. My wife went to the store. So I was traveling this weekend. As you know, I went to had to go to Vancouver for a speech, and while I was gone, she went to the store. Usually she and I, that's kind of our little Sunday thing. We get up on Sunday morning, we have breakfast, we go do our grocery shopping together, we spend some time together doing that. And that way I get to make sure I get what I want. But, she was very nice and decided to go grocery shopping. And so she bought our milk that we use. And I noticed this morning as I was, getting ready for work that I looked at the milk carton and it said expiration date, February the 30th. Yeah.
Awesome.
Just curious. Who was putting the expiration dates on the milk? So apparently I have milk that either never expires.
It's the gift that keeps on giving.
Yeah. We were talking about off the break that, one thing you can get at the store without any difficulty, egg whites. Just saying.
So we go every weekend, Shauna and I, we have a date at the grocery store as well.
Yeah. We should hang out together. We should double date at the grocery store.
We should double date at the grocery store. Maybe that's a thing.
It's an old thing.
I know. My life is so exciting, right? I live on the edge.
Yes.
But going back there, there's a lot of talk in the chat this morning about eggs. Going back there and getting the eggs that we like, and they have signs about one per customer, or there's a limit going on with how many eggs you can buy, or there's off brands. And I've never seen a crowd of people around eggs so much in my life trying to figure out what to do, because it's like their lives have been disrupted, that they can't get the normal eggs that they want to buy. Like,
right.
Just grab a carton. Come on, let's go.
They're all eggs.
They're all eggs.
Exactly.
Yep.
Like I said, buy egg whites. Better for you anyway. So keep you young. So a couple of things real quick. John and I have got quite a few questions that came. So, Danny and Richard do a great job with Candid coffees. And, these Candid coffees started out as just this idea of having, just kind of some office hours for, clients, prospects, whatever, to show up. And it's actually kind of grown into a nice little thing where, they talk about, financial planning topics or whatever it is, Medicare, Medicaid, kind of those big issues. And, it always generates a lot of questions, and of course, sometimes there's too many questions to cover, and so there were some really good questions this time around, and so some of these we'll kind of pick up on today with John. But before we get there, I just wanted to so this past weekend, because of travel, I wasn't able to produce a newsletter. So today on the website, I did publish the all the technical statistics that we cover in the weekly newsletter. So if you haven't read our newsletter, you subscribe for free online. I send it out on Saturdays. The first half of the newsletter is generally covering market topics of kind of what's happening, either economic data, financial data, whatever, kind of a theme, kind of a theme. The last half of the newsletter is all market statistics, right? So it's our technical gauge, it's our fear greed gauges, it's our stock screens, it's risk reward measures, those type of things. So all that's in there to help you better navigate and better position yourself, for the week to come. And so again, that's free. You can get it on the website. If you subscribe to me at Substack at Lance Roberts, you can. I publish it there as well. So plenty of ways to get it and to help you kind of navigate your positioning better. But one thing that really jumped out this past week, and I didn't realize it, was just how much FOMO has returned to the markets. And it's really actually pretty incredible. This is a chart of retail sentiment, which is at record highs right now. Just, retail investors are literally just kind of off the chain about trying to get money into the market. And we haven't really seen this since right at the end of 2021, when investors were just, they were getting $5,000 checks and markets were going up, and it just doesn't seem like stocks would, not go up anymore. So they just couldn't get in fast enough. And we're seeing that now, but even kind of much more of a record level of this. And then, if you slip past that and look at just their net flows. So this is how do you feel about the market? This is the interesting thing we're going to get to here, right? How do you feel about the market? It's awesome, right? Can't wait to get in. Well, what are you doing about it? Well, I'm putting all my money into the markets. And we're seeing a very sharp spike of people just putting all their capital into the financial markets. Again, nothing wrong with that. Look, I'm a big fan of people investing. I think it's great. But when you're chasing markets at the degree that, retail investors are doing it now, you typically see that kind of near market peaks. And that's and again, it's kind of always the case. Retail investors kind of do everything backwards, right? They buy high, they sell low, and we have plenty of historical evidence. This is a chart of the American Association of Individual Investors. This is the allocations to stocks, bonds, and cash. We're right at levels that outside of the dot-com mania, where the AAII allocation to stocks were a bit higher, we're basically at levels that we have been at kind of every single market peak going back historically. And despite the fact that you hear all these rumors, right? It's like, oh, there's all this cash on the sidelines sitting in money markets. No, it's not true. The average investor does not have that much cash sitting in cash. It's mostly invested. Their allocation to equities at some of the highest levels on records right now. All the money market cash is corporate cash. It's Buffett's $150 billion in cash. It's Apple's $100 million in cash. It's Microsoft's $100 million in cash. That's where all that cash and money markets is. So these institutions are the ones that have, this kind of very large predominant cash balances that are sitting on the books. So when you hear people say, oh, there's some money on the sidelines, there's not. It's mostly invested right now. And the cash you do see in money markets is mostly corporate cash that's not used for investing. It's used for other stuff, payroll expenses, CapEx, et cetera. One of the charts that we publish every week, though, in the newsletter is the market sector relative performance chart. And it's a 6-panel chart, so it covers a lot of data. But what this shows you is how is every sector and market kind of performing relative to the S&P. And what was interesting is right now, as opposed to last year, we have every sector and market from bonds to stocks and international stocks, emerging markets, all performing with the S&P, and in fact, a few sectors significantly outperforming as well. But when we and the market's not egregiously kind of overbought, where the market's kind of stuck in the middle of, and that's sorry, that's the dots at the lower left hand corner. The median and average of the S&P 500 stock is not really overbought or oversold. We're kind of just stuck in the middle, and that's because of this consolidation that we've been in over the last couple of weeks in particular. But there are areas of the markets, like international as an example, that is very overbought, and areas that are very oversold, like energy and basic materials and industrials. Though, and again, we were talking about kind of rotation within the markets. We may see money flow into those areas coming out of these areas that have been egregiously kind of overbought here just recently. We'll see what happens. But, this is kind of critical. We also talk about, kind of how investors are allocated to markets as well. And so we have this fear greed index. Now, this is different than the CNN fear greed, right? So CNN's fear greed index actually has the S&P 500 in it. So you're using an index in a measure of an index, right? You're measuring an index against itself, right? So it's a little bit different the way that that index works. This index is based on, okay, how do you feel about the market and what are you doing, right? So am I very bullish about the markets? Am I very optimistic about markets, and am I putting my money into the market? And yes, the answer is yes. As we saw a minute ago, retail investors are kind of going crazy right now. Professional investors are starting to play catch up here a bit. So we're certainly in that more greed area of the markets, which again, we're not at a level that suggests you're near a short-term market peak of any magnitude. You normally need to be above 80, 85. And when you're at those levels, those have been very consistent with previous market peaks. If you get above 90, you're there. You're at a market peak of some sort. And you're going to have some type of correction, 5, 10%, whatever, maybe more. But, we're certainly in that kind of greed category right now. So again, kind of just, when you kind of look across the board at, kind of where markets are, there's certainly some levels of concern. There's one chart that we don't produce that we use internally, and I do show you this chart from every now and then, but this is our weekly risk management chart. Now, importantly, this chart measures weekly trends in the markets. It basically measures weekly momentum, and it uses a couple of indicators to measure momentum, both short-term and long-term. Now, this is weekly data, so it's very slow to move, but it's got a very good track record of helping you understand when markets are very, very extended or overbought and when you're potentially getting set up with a bigger correction. And we're kind of at levels now that suggest that within, again, they could be a year from now, right? These can stay this way for very, very long time. But we're at tops of long-term trend channels. We're at tops of historical momentum channels. And those suggest that we're likely getting set up for a bigger correction at some point in the future. Again, this could be like 2021. We have a year where this market just grinds itself higher before you kind of get into that corrective cycle. Could come sooner, but it's certainly, this is certainly a chart. Now, this chart's all in the blog post today that's on the website, realinvestmentadvice.com. So I updated all the charts for you from this weekend's newsletter. But that one in particular is one to pay attention to help you manage your risk better over the course of the next year or so. All right, be right back after the break. Pick up those questions with John Penn. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife likes to open up the house. She had this idea that said, hey, can we just put a little black fence around the porch? And you have to submit all this to the HOA.
The Real Investment Show podcast.
They sent back this letter. The fence is disinharmonious with the neighborhood. Not disharmonious, not inharmonious. We had to get it all in there. It was so inharmonious that we had to do disinharmonious.
That's our word for the day.
Yes, disinharmonious.
Same show, your schedule.
So what are you going to do?
We're going to put bushes up.
And then put the fence up.
And then put the fence up. I could just say it was there to help the shrubs. Good idea.
Topiary support.
Topiary support. I like it. I like this a lot, actually.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
right, welcome back to the show this morning. So real quick, John, just before we get into questions, there's a bit of a debate going on talking about charts.
Okay.
In the chat right now.
If the chat is alive and well this morning.
So we'll just clarify this real quick. So the comment is a chart tells you something that will happen sometime in the future, which you can absolutely nothing you can act on, which is very incorrect. The reason you use charts, and the reason we use charts the way we use them is to manage risk. And as you know, and again, Brent will come back to this chart. Can you bring up this chart again real quick for me? Just the top half where the gray is. This chart is something we track live, and we've been running this since 2007. And this is how we manage risk in portfolios. And what you'll notice in the background of the chart, and again, if you're driving this morning to work, listening to the radio show, you can grab our blog post on the website when you get home, and this chart is in there for you. But the gray shaded area in the background is our exposure to stocks. And when certain indicators are being triggered and we have confirmation of those indicators, we start reducing risk in portfolios. Again, this doesn't mean that a correction is going to happen tomorrow by any stretch of the imagination. And it also doesn't mean that when the market bottoms that you're going to buy the absolute bottom, right? That's not what charting is meant to do. It is to help you manage risk and to navigate risk. And so when you start getting a series of indicators that you are very familiar with and very adept at using, it can help you increase or reduce risk in your portfolio to specific stocks, specific markets, specific areas. So absolutely, these charts can tell you what to do. Now, right now, we have a lot of warning indicators going off. There's still two indicators that are keeping us in the market. One of those is money flows, which are still very positive. And the other is basically sentiment at the moment. We haven't seen the turn in sentiment just yet. Now, once you start getting the supporting indicators to come into play, we'll start reducing equity risk in our portfolio. In fact, we may start doing that. Mike and I were just talking about this yesterday. But using charts tells you everything you need to know about the markets. It tells you how to manage risk. It tells you how to increase your exposure, how to reduce your exposure. It doesn't tell you what event is going to cause it. No, absolutely not. It's not going to tell you that tomorrow morning you're going to wake up and that, you can take that chart down, Brad. Thanks. Not going to tell you tomorrow morning you're going to wake up and that, there's going to be some, geopolitical event or some economic event that causes a major crisis in the markets. But what these charts do tell you is that the market is set up for an event to cause a significant correction in one way or the other. And again, it can also be in the middle of a bear market when you think that nothing's going to, stop the market from going lower. These indicators also tell you that it's time to start buying. And just over the last couple of years, if you've listened to the show at any time over the last 2-3 years, we have talked about. Last year is a good example. In February, we said, hey, markets are telling us we're about to have a 5% correction. We had one in April. In June, markets are set up for a 5 to 10% correction. We had one in July, 8.5%. Year before that, we talked about the 10% correction that we were going to have during the summer because markets were in that condition. And we also told you the other side of that is like that condition is set. And we have now probably finished that correction. Time to start putting money back into the markets. And again, this is a very good reason why, if you're just listening to the radio show, you're missing out on the most important stuff to help you manage your portfolio. Our daily market commentary comes out every morning at 7:30. Our weekly blog post and our weekly newsletter. Because if you go back and look at the history, when we make changes, we post a written document, why we're making changes, what's driving us to make those changes, and in our newsletter, we post what trades we're actually making. So if you're not paying attention to what we're writing, you're missing 90% of the information. It's great. We love having you here in the morning on the YouTube channel. It's absolutely fantastic. Glad you're here. Please hit the like and subscribe button. Share it with your friends. We certainly need more subscribers, but this is 10% of the information we're putting out. The other 90% is what's going to help you manage your money better. And we are very transparent about everything that we do. John, you're nodding your head over here.
No. I mean, as you and the team are doing the research, looking at markets, economies, whatever, the political environment, the interest rate environment, whatever it is, you form that research into an article, and it's on our blog. It's there for everybody to use, right? It's a wonderful, wonderful resource. And I really like what you were talking about, the charts. And to your point, nobody can predict the future, right?
Right.
But if you have the set of data that you have followed over a long period of time, the chart, what the charts do help you do is form a discipline, right? As an investor, where you're looking at data where you go, okay, based on some historical trends and looking at what I'm looking at today, hey, things are overvalued. Guess what? I'm gonna trim a little bit. Just take some profits. Now, can things go higher after you trim? Sure. But at least it forces you to take some profits along the way, raise some cash, just some risk management. Markets pull back a little bit, oversold. It's a better buying opportunity? It's so many times still. How many folks that we visit with since the great financial crisis, they've been in cash and they have been waiting for the perfect time to invest, because I know I'm going to get this at the rock bottom price. Guess what? The rock bottom price might never come.
Right. And the rock bottom price might be a lot higher than you thought the rock bottom price was.
Exactly. So at least if you're following this from a charting point of view, if things pull back a little bit, you may not get it at the rock bottom price, but are you at least trying to get things at a better value than where they were before? Absolutely. Right.
Exactly, and this is the whole point. So again, charting is a very important part of managing your risk, and that's it, right? I mean, it's just trying to just buy and hold markets is fine. It works as long as markets are going up. Eventually, you lose 50% of your money, and then you spend 5 to 7 years getting back to even. That's not the same as making money. Charting can help you learning the very basics. Again, we've done some shows on technical charting in the past and how to use it. It's not an absolute. It's not going to guarantee you to be right out the top or right in at the bottom. That's not what charting does. It doesn't predict what's going to happen in the future, but it just tells you that the conditions are ripe for something to happen. And it's the same as driving really fast down the road. I can speed as long as the road is straight, but if a curve suddenly comes up and I don't take my foot off the gas and hit the brakes, outcomes are probably not good. And that's what charting tells you, is it tells you when there's a potential change in the road ahead of you and what's going to happen. Yep. So, all right, look, we got a lot of questions to get to, and we got sidetracked there with that. Appreciate that, John. So what, you got like 17 questions. We're not going to get through all these today. We'll kind of pick at them over the next few days that you're here, but pick a couple that really kind of jumped out for you.
Yeah. So over the weekend, the Candid coffee that Rich and Danny, collaborated on, it was really about how to generate income in retirement. And we get a lot of questions around this. Mm-hmm. And one of the questions was, well, how do I generate enough income? Let's say if I have a portfolio of $1 million, right? How do I generate enough income using $1 million to last until I'm in my 90s? Sure. Right. And I think the answer is and this isn't the answer that you probably want to hear, but it kind of depends on how much income do you need, right? And are you solely relying on this money to generate the income that you need? What are your other sources of income? Do you have Social Security? Do you have pensions? Do you have annuities? I mean, there's a lot of different ways that you can look at this. Are you just going to put that $1 million in a portfolio of treasuries and collect 4%? Is that enough? Right? It seems that with rates maybe coming down a little bit here, we're getting a lot more questions around some of the more, how can I say,
esoteric?
Yeah, esoteric. What about business development companies? What about, collateralized loan obligations? Mm-hmm. Things along those lines that are paying a more attractive dividend yield. And hey, just how safe are these, or what are the pitfalls that I should be paying attention to if I were to introduce some of these types of investments in my overall portfolio?
And investments like that, like BDCs, business development companies, CLOs, collateralized loan obligations, these are all fine until they're not.
Right.
And this is always the problem. And again, we kind of go back, and here's the mistake that investors repeatedly make, and I see this all the time. And let's just use Walgreens Boots as a good example, right? Walgreens Boots just recently, they're on the verge of bankruptcy now, and they just cut their dividend to zero. They had about a 6% dividend yield before that happened. So just an example is like, well, Walgreens Boots, it's Walgreens, right? That's not going anywhere. That company's not going anywhere. I can just buy that stock. I really don't care what the price does. Price can go up or down, don't really care, but I'm going to get 6% of my money. Sounds great, right? And you look back at their dividend history, it's very strong until it wasn't, right? And this happens all the time. We saw this during the financial crisis. We saw this during 2022. You know, all these things, and there's a lot of new products that are out, covered call option writing strategies and all kinds of stuff. It's going to generate, 10, 11, 12%. Those are all fine as long as markets are rising. They're not fine when markets start to come apart at the seams. And again, so you may get some, nice return over the next 3, 4, 5 years. Then you lose 50% of your money or more. And some of these have a real tendency to lose a tremendous amount of value during market crashes. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
One more thing about yields real quick, and then we'll move on from there, is that whenever you're measuring something in your portfolio and you go, oh, this has an 8% yield, that is the risk you're taking over a risk-free yield. The only thing that is risk-free, and again, whenever you look at something and it says, and you put the word safe in front of it, and again, here was the question to be specific. I'm interested in your thoughts on BDCs, CLOs, senior loans, MLPs. These seems like very underway to get consistent, safe yields above 8%. Whenever you have the word safe in front of any number, it can't be more than the yield on a U.S. Treasury bond. That is the de facto risk-free yield. And in the markets, the only thing that you can say is risk-free is the U.S. government debt. Anything above that or anything other than that has risk to it. So if you're wanting double the yield, you're taking essentially double the risk. If really it's much more than that. It's about 3 times the risk to get that yield. And yield is only a function of the dividend that's being paid out in cash versus the price. So in other words, if I have a stock trading at $10 and it pays, a dollar in yield, right? I've got a 10% yield. If that stock falls to $5, I lose 50% of my money. I've now got a 20% yield. Sounds great, right? I'm getting 20% of my money. Well, why did the stock just lose 50% of its value? Right? So again, it's all fine. Again, and the big mistake that investors make is they go, oh, I don't care about the price. You will care when your $1 million portfolio goes to $500,000 and all your yields go away, which happened during the financial crisis.
Great example. So we get a lot of questions, and look, I'm not talking bad about business development companies.
No, it's just an example.
It's just an example,
now,
right?
MLPs were the same way.
Yeah, same thing. So you look at some of these, like, and I'm going to pick on this one. This is not a recommendation. I'm just putting this one out there because this is a pretty large, well-known business development company, and it's Pennant Park, right? So you look at Pennant Park right now. Pennant Park pays a yield of just under 14%. I think it's 13.8%. Go back and look at how Pennant Park behaved, not just Pennant Park, but go back and look at how business development companies in general or that group of investments performed during Q1 of 2020. Right. At the end of 2019, getting October, November of 2019, Pennant Park was trading around $6 a share. Okay, right now it's hovering around $7, a little bit north of $7 a share. During the sell-off, during the economic shutdown, when stocks were just selling off in droves, Pennant Park went from $6 down to $1.76. Okay, that's a big move. So to Lance's point, it's great that you're collecting the dividend, but what happens if all of a sudden, whatever is producing that dividend is down? What is that, 60 or 70%?
Yeah, exactly.
Right. So you got to look at this and say, okay, if I'm willing to put something like this in my portfolio, what's the right balance? And there are many clients that I work with that outside of what we assist them with, maybe they have a sprinkling of these in their portfolio, but they also understand how they work and they understand how they're going to behave. And more importantly, they don't just understand how the investment will behave if we get into some more volatile periods, but they understand themselves as an investor and how will they behave. Mm-hmm. That's the key. Emotionally, how will you behave if something like this that you own in your portfolio all of a sudden wants to go down 50 or 60 or 70%. Right. Not saying it will happen,
right?
But it could.
But that happens, right? Annalee Mortgage is another one.
Yeah.
It's a position we actually own right now. Has a nice yield to it based on mortgage-backed securities, which, by the way, Ginnie Mae mortgage-backed securities are another risk-free investment because they're government guaranteed. But, this is a stock that went from, $22 in 2020 to $8. Right. And then it rallied all the way back to $23 and then it went back to $10. That kind of volatility is very, very, and the dividend doesn't change, right? The yield's all over the place because of the price. So if you can buy it cheap enough, it's been good. But anytime you have, interest rates going up, it's very interest rate sensitive because it's mortgages. Mm-hmm. And mortgage-backed securities have what's called a prepayment speed to them based on the mortgage rates. How fast do people pay off their mortgages when interest rates are rising? So again, very volatile, very solid company, pays its dividend on a regular basis, but that yield is all over the place because of the price is all over the place. And so as long as you can withstand the 50, 60% drawdowns, that's very difficult. Fortunately, it's always recovered up to this point, but there's very long periods where you've got really big red spots in your portfolio that weigh on you emotionally.
Right, and then that's where you have to make the decision. Are you good? Well, did you trim it before this happened? Are you managing the risk of that position in your portfolio along the way, or all of a sudden one morning do you wake up and there's some curveball that you didn't expect and it's really pulling back? What are you going to do? You got to think. You got to think forward a little bit on how you would act in that particular moment.
Yeah, and the other side of that is also sizing and weighting, right?
Yeah.
You don't. If you're building your whole portfolio and you've got really big positions and these things, like, I'm getting a 10% yield on this, whatever it is. And again, that goes down 30, 40, 50% and then cuts its dividend, you're in a lot of trouble. And again, this happens often, so these aren't like one-off events that this occurs. So, sizing and weighting within your portfolio as well. How big of a position is it? If that position declines 50% and it cuts its dividend, what does it do to my overall portfolio? And if you're taking sizable impact, and that's just a good math exercise to run in your portfolio on a regular basis, right? So just, build a spreadsheet, put all your positions in there, weight them based on their price, and then put a drawdown scenario, and then see what the impact is to your overall portfolio. Go, can I live with that? And if you can't live with that or don't want to live with that, that's a good opportunity to rebalance that risk and diversify maybe into some other stuff. And again, John and mine, there's nothing wrong with any of these to own them, right? You just need to understand what the risks are, and these are not risk-free investments. They're not safe yields, and that's the real point.
Yeah, you just kind of, and this goes back to kind of know what you own, right? So many times to this day, there are a number of folks that I visit with who come to us, and they have a portfolio of securities, and they'll say, John, honestly, I don't even know why I own these, or I don't even know how I got these. These are just recommended to me, or it was tips from my neighbor, family, what have you. And I just, that's why I have my money in these. But you really have to, it's like a car. You got to open the hood and kind of look at what's driving you forward. How does this all come together, right? So kind of goes back to that point of kind of know what you own. And, a lot of questions that came over the weekend, too, from the Candid Coffee, it was very much around, well, what percentage of my portfolio should I put in stocks? What is what percentage of my portfolio should I put in bonds? Or if I'm going to bring in dividend-paying stocks to my portfolio, is there a magic number? Or is there a one-size-fits-all? And the answer is no. Yeah. And a lot of times you hear about, well, a good way to gauge how much equity exposure you should have in your portfolio is take 100 minus your age, and boom, that's exactly what you should have in stocks. And my argument to that is risk knows no age. I mean, there are folks that I work with in their late 70s, early, mid, late 80s. And if I ever mention the word bond, or let's talk a little bit about this, bond is literally a 4-letter word to them. They do not want it. They do not want it. And then there are folks that I work with that are in their mid to late 30s, early 40s. And there's some of the more conservative folks that I work with. And so there's really not a general rule of thumb out there. It really just comes down to, what is your specific investing persona, and then position your portfolio accordingly, right? And I think sometimes, folks are, right now, a lot of folks are, really looking for income, and, they kind of get lured into having a portfolio of 100% dividend paying equities. Well, that's great. You can collect the yield, but you got to take a look at, well, this is a portfolio of 100% stock. So are you willing to, there's upside potential, there's growth potential, but there's also there's also risk for volatility. So these are all the pros and cons that you have to think about whenever you're putting a portfolio together.
Right. And, this goes for preferred stocks.
Yeah.
It goes for MLPs, it goes for BDCs, just anything that you're using. Preferred stocks are really interesting because you get a preferred position. So in the event of a bankruptcy, you're ahead of equity shareholders, you're behind bondholders, but you do have a preferred position, right? So you get a little bit of the equity increase, right? So it will go up in price to some degree, but these are generally issued out at $25 a share. So there's kind of a premium that you're going to get. So it might go, if it's just out at 25, it might go to 26 or 27, but the stock could go from 25 to 100 and you'll get a couple of dollars of increase in the preferred. But the preferreds are fine. But again, just like all these other things, a good example is we were talking about Annalee Mortgage a second ago. Their preferred fell by over 50% in 2020 as the Fed was hiking rates and, we had inflation, those type of things. Again, but I own the preferred just for the income, and now you've lost 50, 60% of your money at that same time. Now it comes back. It came back. Fine, right? But, again, very volatile. And again, the point that we're making is it's the ability to withstand those drawdowns. And if your whole portfolio is built around these things, then all of a sudden your whole portfolio loses 50% of its value, which is what happened in a lot of these kind of structured portfolios that way, the entire portfolio gets impacted. And you're looking at your portfolio saying, I just lost half my money. What am I going to do? And then you start making really bad emotional decisions. And this is why diversification, allocation, those type of things, so very important to help you navigate that risk. Again, nothing wrong with any of these things that we're talking about, right? They're completely fine to own. We own them. We've owned some in the past. We'll own more in the future, those type of things. But it's part of the allocation process.
Right. It's not an all or nothing. And I find a lot of that still where when folks want to invest,
Very concentrated.
It's either I'm all in or, it's an all or nothing approach. And it doesn't need to be that way.
Right.
Kind of going back to that FOMO, that fear of missing out.
Yep.
You can take a paced approach to this and take a diversified approach, right?
Yep, absolutely. All right, wraps up the show for the day. We got through one question.
Yeah, maybe two. So there's plenty.
Next
to
week, we'll just
elaborate
roll
on.
some of these over onto next week. So I'm sure Danny and Rich will be covering some
Absolutely.
as well. All right, that wraps up the show for today. Be back tomorrow. Be sure and like and subscribe to the channel. We appreciate it very much. Trying to grow that channel as slowly as we can, right? But it certainly helps us very much. We do appreciate it. Also, get today's blog post on the website. Like I said, if you're not getting to the website, realinvestmentadvice.com, you're missing a whole lot of stuff to help you manage your money better. Have a great day. See you tomorrow.